Good afternoon, everyone, and welcome to episode 3 of the Valuation Edge podcast here with Biz Equity. My name is Kevin Saad, Senior Director of Customer Success here at Biz Equity, and I am very fortunate and excited to be joined today by a longtime Biz Equity user, a great partner of ours going on more than a decade, Mr. Bob Tankesley. Bob, thank you for taking the time to join us today, and really excited to dive into the world of valuation and specifically your experience in the marketplace and the exit planning space over the past decade plus.
That's great. Thanks, Kevin. Thanks for having me. All good stuff. Like you said, I've been, I guess, a power user for a long time. Probably shortly after you guys launched. Don't remember what year that was, but yeah, we'll get into it. I'd like to help your listeners understand if they're not using Biz Equity now, they really should be.
We absolutely appreciate you taking the time, and hopefully that's their takeaway by the end of the conversation today. So for all of our users out there, again, just a little bit of background on Bob and his experience, again, being a longtime power user of the platform. Bob's a fourth-generation entrepreneur serving as M&A advisor in the Metro Atlanta region and the founder and author of Exit Teams. And in terms of his experience working with business owners, he's worked with hundreds of them for more than 25 years in various capacities around the United States, predominantly in the area of finance. And he's a founding member of the Atlanta chapter of the XPX nationwide network of advisors to business owners working in a highly collaborative environment. And when he's not focusing on the business owner community in the southeastern U.S. and nationwide, he's probably spent some time in some of the beautiful hiking trails and scenery in southeast U.S. and the Georgia area specifically. So I know Bob and I have shared some conversations around hiking in the past, and I think it's a little bit more spacious and more options down in your area. Hopefully it's going to be a good run here for the next few months to get out there and spend some time in nature.
Yeah, seriously. And just as an aside, one of my kids and I, this fall, actually, we're going to do the Georgia section of the Appalachian Trail. So looking forward to that.
I love it. You're going to have to give us a full recap. I had the opportunity to go to Montana for the first time to the Glacier National Park last year. And
nice.
We hiked for 3 days around the 4th of July holiday, and it was absolutely incredible. So looking forward to it, and a great way to bond and spend time with family outside too. It always makes it more special when you do it with your son.
Yep.
Awesome, Bob. So going back to your experience, again, just your background, like we just touched on a bit, can you just tell us a little bit about specifically, exit teams and a little bit about, your founding of the firm when it comes to specializing in this space in such a crucial time with business owners?
Absolutely. It would probably help to give just a very brief background before I founded Exit Teams, how I became a Biz Equity user and saw the power of valuation play a huge role in business owners' lives. About 25 years ago, I set up my own CPA shop. Bolted on financial services. So for those of you listening that are currently financial advisors, I was one too. Always had a niche of focusing on business owners themselves. And, it occurred to me pretty early that a massive amount of their net worth is tied up in the company, a very illiquid asset that they're trying to grow and do something with, maybe sell someday. But they never quite knew exactly what number to give me when I would ask them, for the number that represented the value of their business, which was, often a huge piece of their personal balance sheet, the asset side. So then I found Biz Equity and I thought, oh, this is fantastic. I can now answer that for them. I can move them from that. I don't know what you guys say. It's like 97 or 98% of owners who don't know the value of what they've got. I could move them now to the 2 or 3% of business owners, put them in that elite category of owners who now understand what value to put on their company, and then roll that valuation forward each year. Fast forward to about 13 years ago, I started doing mergers and acquisitions work in the lower mid market. Generally speaking, I define the lower mid market as somewhere around 4 to 5 million in gross revenue on the low end. Who knows where the upper bound is, 40, 50 million, 60, 70 million on the high end of gross annual revenue. I do transaction work for them, mostly sell-side work. All of that conversation, as you might expect, starts with a solid understanding of what that range of values might look like before we even go to market. So that's what Exit Teams is all about today. It's making sure that owners have that fully built out collaborative team of advisors around them. You could start with the core deal team, like the wealth advisor, the insurance agent, the valuation person, the CPA, an M&A person in there, and various attorneys. And then you can expand out from that, in my view, from that core deal team and encompass all the different types of consultants and service providers and fractional folks that could come around the owner and get that company ready for prime time. That's what Exit Teams is all about.
Fantastic. I appreciate you sharing, Bob, and we appreciate you, supporting us and being part of our journey since the very early days. So it means a lot to see you evolve with us and have success, especially in the multitudes of your areas of expertise. And I think, especially with how you came to where you're at today with Exit Teams, I think it's so great that you have a perspective from so many different lenses on the advisor side, the CPA side, and then also now the M&A and the exit space, which I think gives you, again, that unique perspective from all those areas. And from there, if you want to maybe just share a little bit more maybe about how you've seen it evolve when it comes to the space. And like you said, that 98%, which we think maybe it's down to like 90 or so. Thanks to Biz Equity a bit. We'll take some credit for that. But
you guys are fighting the good fight, bringing that number down.
yeah, I doing everything we can, and you're a big part of that. Tell us maybe just a little bit about how your approach with utilizing the platform and the positioning is now, given, like you mentioned, the market you're working with compared to the early days with Advisor, maybe some of the differences, but also just the constants when it comes to fighting that good fight and delivering value across the board.
So I always start with the owner, asking the owner, hey, if you went to market today, what do you think you'd get? just a point blank question. And they probably have some kind of understanding. They probably have some notion, some number in their head. Private equity's got a hold of them and has dropped a number. They're watching what companies in their space are selling for, and they think they've got kind of a rough estimate of how to price those. Sometimes the owner will tell me, Bob, I need $15 million out of this transaction, and so that's what I need. That's what we need to be targeting. That's what I need to wait until we go to market at, when my valuation of my company is at or close to $15 million. I hear a range of responses. And then I say, well, would you like to test that? Would you like to see what market would bear if we go to market with your company? What a range of offers might look like from different types of buyers. And I'm talking private equity, strategics, maybe family offices. If the company is small enough to where PE might not look at it, that business might be bought by a private individual, maybe going to SBA for funding, maybe a conventional loan, or pulling some investor money together. I asked them, would you like to know with better certainty what that range of offers might look like? And in a lot of cases, I get a yes as the response, because they realize that they don't have a solid understanding. Let me back up. We all know that baby boomers used to own the majority of small businesses out there. Baby boomers, I heard a long time ago, back when I was a financial advisor, this is like 25 years ago, that the boomer demographic was basically and realistically two separate demographics within one generation. You had the earlier, born first portion of the baby boomer generation. They, live for today, forget the consequences. It's all about me, that kind of thing. At least that's the label that was put on them by future historians. The earlier, more young demographic within that generation, I think they looked at their older siblings and their older friends, and they said, "Not me. I'm not going to make those kinds of mistakes. I'm not going to make those decisions that get me into that kind of trouble. I'm going to be a little more planning in nature." That difference rather, stuck with me for a long time. And then somewhere along the way, I heard that Gen X, and maybe it was about 4 or 5 years ago, it was definitely pre-COVID, the Gen X generation seems to be more planning in nature. They seem to want to sell their companies sooner than the boomers did. So I'm pretty optimistic for Biz Equity users, because I think we've got a good 15, 20-year run here of more and more owners that are interested in thinking about the future. that are interested in what their valuation is today and how to get it to some number later. You guys have bolted on the exit readiness assessment. That's been a beautiful tool. I've gotten in there. I've played with that. Good job on putting that together because it's another game changer for the industry.
I think that's tremendous insight because, like you said, we've heard about the silver tsunami, for many times. It's something we've always been preaching, but we mentioned it on previous podcasts as well. It's already here, and now that's the current wave. But like you said, just like for all of our users who are heading to the beach on the upcoming Memorial Day weekend, the wave's going to keep coming. There's obviously another generation of business owners, and they might be more planning focused. So, while we're thinking about the present and the current opportunity, like you said, we're very bullish on the next 15 to 20 years as well, which is why we felt it was the time to make those updates and just put those tools in your hands, which we love to hear you're already utilizing them. So to touch a little bit more on that in a segue, Bob, when it comes to the readiness and going through those questions and also the exit valuation portion of closing that value gap, two of those updates that really go hand in hand. Can you tell me a little bit about maybe what you've seen when it comes to some of those potential deal killers? I know you mentioned on some of your podcasts in the past, some of those areas where once you're getting into that exit planning conversation, they aren't necessarily top of mind showing up in the financials, but once you ask those questions, you dive deeper with the business owner, they really come to light and how they're impacting them, not just today, but also for that future exit tomorrow.
I think you have to answer that question, you have to start with the 5 subjective questions that Biz Equity has been consistently asking its users to get answered from business owners. The rate of revenue growth over the next 3 to 5 years, intermediate term, the EBITDA margin over that same period of time, the customer concentration, the rate of recurrence of revenue, call it the annuity question, and then that all-important question that every single buyer I come into contact with tries to get answered in the first 2 or 3 conversations, and that is, what happens to this business if something happens to this seller? That owner dependence question that you guys asked from, hey, if this owner's not here, everything remains the same, all the way down to, wait a minute, this business is not the same. This business plummets. Revenue, bottom line, everything plummets. This business falls apart when the owner's gone. So you have to get those 5 questions answered with solid responses, not pie in the sky type of responses, but realistic responses. Because if you're going to go to market and you think your company's worth 10 million based on optimistic responses to those answers, but your buyer is coming in, the one with the check, the one with the money that they're going to be borrowing, the one that's going to go to investors and try to pull the capital together, what they're willing to pay is what really needs to be taken into consideration. So I would encourage Biz Equity users, if the valuation is for purposes of going to market now or at some point in the future, and trying to have a rough market estimate of what that range of offers might look like, answer those questions as conservatively as possible and push back on the owners with the responses that they give. Dig in and make sure that those slider bars are used correctly. Beyond that, you've got the ability with the extra growth, the ability to show future revenue, future forecasts of the company, and project out what business valuation might look like. That, to me, I thought you guys really broke the mold when you came out with online valuation, but to then step it up and say, we're gonna kind of recast the future. We're gonna say that we can't necessarily capture everything by the answers to those 5 questions. Let's go further and let's see what this company, if everything were done right to it, and if the company were really tuned up and optimized, as I say, and getting made ready for that future buyer pool, what could the company look like in the future? What could that growth look like, and what could that value end up becoming? I'm getting goosebumps. It's really nice because think of what a team of experts, mid-market or McKinsey level people would have to charge to come in and dig into a company that size, which most business owners probably aren't going to pay for, and here within a matter of moments, days, however long it takes to come up with that diagnosis, you're able to provide some really meaningful information back to the owner. It's amazing.
It means a lot coming from you because you've seen the journey, like you said, from the start and evolve, like you said, from pioneering the space and really just starting out with our mission, which is still true to today, of democratizing the process. And like you said, to see it really come full circle and compounding off that, that's really with any future updates, with everything we rolled out in the last 12 months, what's to come in the future. Always coming back to impacting the business owner, but also the user like yourself. That way, it's a win-win for everyone, and you're really, like you said, able to provide that high-level consultancy, which you would only find on a Wall Street in the past, but bring it to Main Street to the ones who are powering, the economy, the backbone that you're talking every day.
This is crucial. I mean, let's be blunt about it. There's not a strong likelihood that even a company taken to market gets sold. Here's the quick math. 4% of companies ever get sold. Only about 20% are ever taken to market, and only about 20% of those ever transact. 20% of 20%, 4%. That's the dismal statistic. And that's the thing that a tool like BizEquity can help increase the odds of. When an owner knows years in advance by some type of benchmarking process, value benchmarked and then re-upped every year or 2 to 3 years, becomes better in tune, I think, with how a buyer thinks. That's the basic premise of my book, was to let owners inside and see themselves in some future transaction with a buyer before it even gets here. And that conversation, in my opinion, has to start with a knowledge of value, how value works, what are the buttons to push, the levers to pull to drive value, and slowly getting that owner over time inside the mind of a buyer. That said, it doesn't mean that we're prepping the owner to take some lower offer in the future. Be prepared and be ready to settle for some lower offer in the future. That's not what I mean by think like a buyer. What I mean is, if you want top dollar, if you want to position your company to be an elite company, you want it to stand out among its peers when you go to market, when you want to optimize it for a professional level buyer, and they're getting more sophisticated. Again, I'm talking about private equity, strategics, family offices, high net worth people with teams of advisors around them. If you want to truly get ready for prime time, you want to optimize that company. You want to build a company that those sophisticated buyers with large amounts of capital want to pay a premium for. That's what I'm talking about when I'm saying think like a buyer.
Yeah, it's such a great perspective because, like you said, it's almost like you're game planning for a game, right? You're thinking about the opponent who you're going up against. When you have these offers coming out left and right, and like you said, the only way to really prepare and truly be ready to deliver performance, it doesn't matter if you're trying to go out and win the Super Bowl, win the World Cup, the NBA Finals, the World Series. You're doing your research in advance. You're tuning that team up, and you're working with their team to get them to that elite level. Because I think there's so many parallels. That's what I've really seen in a lot of our conversations with clients, podcasts alike, is there's so many parallels with business owners and sports, just the competitive nature. And I think, like you said, especially with your decades of experience, you really tap into that, and giving you the tools to have that best in-house staff that prepares them for a game. You're ready to prepare them for the game of life and the game of business. So that's tremendous insight.
That's in part why I went with the Exit Teams brand, label, firm name, whatever you want to call it. It became the name of the book, the name of the podcast, the website, obviously, exitteams.com. Number one, I knew that most business owners had played ball at some point in their lives. They had been on a team of some kind. I don't know what position they played, but by the time the game was over, by the time the season was over, by the time the amateur career playing whatever that sport was over, they knew what it was like to be part of a team. And so I'm reminding them what that concept, though they may want to be, on their own and calling all the shots, I'm reminding them of what that concept of having a team of specialists around them actually looks like. So yeah, you nailed it. I'm glad you said that, because you reminded me. That's why I've honed in so much on the concept of team building.
Especially given the success and growth, it was clearly the right call, and also really important too, like you said, always just to remind it's a team game. We get lost in the day-to-day. I think all of us as humans sometimes, where it's just us against the world, or it's all on our shoulders. But just like in business and life, it takes a team, and having that around us. So I think it was a great way to approach it, and it clearly has paid off.
Plus, exitteams.com was available 2.5 years ago. It had never been owned. I snagged it, so I said, "There's got to be something here. Let's go with that."
There you go. I love it, and sometimes it just when it's teed up beautifully and it all kind of falls into your lap, you got to run with it. So
Yeah.
well done and great foresight there. I want to touch on something you just shared there too with life after sports, life after business, because in terms of all the tremendous work that you do with exit teams and all of our users who find success closing the value gap, working with that business owner to the liquidity event. I know there's a lot of stats out there too about how many business owners regret the sale of their business of that small percent that you mentioned. Can you tell me a little bit, because you see it in sports a lot, the parallels of life after sport for a professional athlete, how tough it can be. Can you tell me a little bit about the emotional side of the exit, the liquidity event, and the reality check or preparing for life after running the business for the business owner? What have you seen just in your experience there?
Let me give a incredibly recent example. As of about 3 weeks ago, I helped a friend sell his registered investment advisory firm. We talked to a couple of aggregators in that space. As a lot of people know, there's a tremendous amount of interest in the RIA business model. My friend had been running this for almost 20 years. The firm bore his name, several employees. At its height, he had 9 employees working for him. We think we found the right buyer of all the different types of buyers that are out there. And the early indications are, yeah, this looked like it was a great fit. Culturally, it fit. Tech stack, it fit. For my friend's point in life, it was a great fit. And so now we're after the dust has settled. The wires have been all given out, and all the employment agreements have been signed, and the clients have moved over, and now comes the part in the process where how to put this, the reality of what's been done begins to sink in. The thing that you can't, and it's impossible to, the thing you can't envision, no matter how much time you dedicate to it, the thing you cannot envision before the deal is done, what life looks like after the deal is done. After all the details have been worked out, the closing's done, things have started to settle. In my friend's case, is what you hope to see with many business owners, and that is the personal side of life is well taken care of, and everything's shored up, and the business is ready at the same time. When those two things are in alignment, you tend to have a better outcome. You tend to have an owner that's more likely that they'll be happy that they sold. Where I tend to see owners regretful, and you're right, it's a very high statistic. I've heard half of owners that sell are unhappy. I've heard three-fourths. I've heard some people say it's even higher. Where we tend to see that happiness is when one of two things happen: the company wasn't ready, and the price plus terms weren't what the owner expected, or the owner themselves wasn't ready, and they felt it almost immediately after the transaction was done. They weren't ready financially. They weren't ready psychologically. Their family wasn't ready to see more of them. They hadn't decided what that the rest of their life, if it meant retirement or semi-retirement, they hadn't nailed that down as to what that needed to look like. The worst case scenario is the company's not ready and the owner's not ready, and that's usually, a disaster type of situation, maybe a fire sale or some type of distressed go-to-market type of situation. But I think if advisors of all kinds will get around owners and make sure that the company is ready and that the owner is ready as well, we can dramatically increase that rate of happiness that owners have after they sell.
Without a doubt. I'm so glad you touched on it. It's so important because, like you said, it's a common trend that we've seen and similar where, they haven't discussed it with their spouse. They haven't really thought about that life after. What does the lifestyle look like? If it's playing golf every day, does it mean, retiring somewhere to a different country, a different part of the U.S., seeing grandkids every day? That success can mean so many different things there. And when it's not defined and those conversations aren't brought in the fold, it can really increase haziness and just make it tougher all around when it comes to satisfaction and not getting the most out of it. And like you said, the statistic I've heard varying as well. I think it's somewhere in the 70s, at least for what I've heard of the number of owners who do regret the sale. But that's
Amazing.
why we thought it was such an important time to bring in the readiness assessment and
Yes.
really get into those personal areas, the other areas that are overlooked. And like you said, avoiding those worst case, but making sure that no stone goes untouched. And it's just a comprehensive way to get ahead of all those conversations and give our users like yourself just an opportunity to have those conversations in the platform, easy to understand and tracked and benchmarked over time until that moment comes. So you avoid all those moments of regret that you can't get back in the long term.
Speaking of the exit readiness assessment, if I could just talk something here about like 30 seconds about that. I really like how you guys aren't just asking questions of business owners in the survey without providing examples. You don't leave it up to the owner to interpret the question in their own way, because I think if they did that, it could yield less than optimal results. You add from I'm drawing from memory. You ask the question, but then there's some statement or of two or three sentences which asks them to consider things at a gut level, at an honest level, and then respond to the question and then provide that answer. And so, with that additional context and providing examples, I think we're getting the owner to think more deeply and consider things that they might not have. The end result of which is for them to answer with a stronger and a more realistic response. And so I applaud you guys for going that extra step and not just asking the question, but getting the owner to gut check themselves before they answer.
We appreciate that, Bob. It's very kind of you to share, and I think it comes back to, as you mentioned earlier, with the sliding scales and now having them in the report and the risk profile there to really bring it to the business owner's attention of what to address. It all comes down to just the honesty of where they're at today to get the most accurate, actionable valuation, right?
Yep.
Because like you said, doing it there, while it might feel good in the moment, it does no one any favors down the road if it's not based in the reality of where they're at today. So just like in those steps, which I appreciate you sharing, because we strongly encourage that and highly recommend to all of our users to dial it in, going through the 8 steps, but also for the readiness, as you mentioned, as users are really starting to adopt it and see the impact. We're seeing that the biggest impact and the strongest conversations, the deepest conversations are coming from, as you mentioned, just making sure it's grounded in that honest assessment of where they're at today, answering as thoroughly and detailed as possible.
Without that built-in bias that they initially want to put in there. I mean, think about it. Here's one of the questions. Does the company have a current buy-sell agreement funded by life insurance? Well, that one's kind of cut and dry. Either they do or they don't. Another question, how capable is the current management team of running the business without your daily involvement? If you let an owner just answer that without pushing back on them with some examples and some alternate ways of thinking, they'll respond most likely. I mean, they're human. They'll respond most likely in a very optimistic way, not thinking about everything from a worst case scenario standpoint. So the end result, again, it'll be a lower score for sure, as you just said, but better to be, as I said with valuation, better to be honest now and aware now than getting 2 months into due diligence and now you're finding out from a particular buyer what 70% of your net worth is actually worth, and it's not numbers that you're wanting to hear. That's a terrible situation for an owner to be in.
I think, like you shared there, when it comes to the lower score, as you mentioned, it's not ideal, but at the same time, it's an opportunity. That's what we've seen is, it's not, especially if you're having the conversation earlier on and really growing and building towards the exit, just like you're having with all of your clients. It's an opportunity to work, to plan together, and to truly build and get them to that point where you're avoiding that long term. So that's what we always say, and what we've seen since the release is, hey, even if it's a lower score, it's an eye opener. Like you said, it's much better to have that conversation, and we see it as an opportunity to go in, take advantage of where they're at today, to go ahead and improve and build together, as opposed to shying away from it and then by just ignoring a problem or any areas of improvement. It comes back to overall bite when you're at the deal table and when the moment of truth comes.
Yep.
Well, this has been a fantastic conversation, Bob. I know we could probably go for hours on end, but one other thing, just given it, as you mentioned, with deals and trends that you've seen, in the space and since founding exit teams. Can you share a little bit about the past few years, specifically around the pandemic and COVID? Just, we mentioned democratizing this process and having the accessibility to those Main Street types of firms. Maybe what you've noticed in terms of trends on the front lines since then when it comes to, maybe that more Main Street versus Wall Street?
Excellent, excellent. I'm glad we're covering this. Yeah, let's give a couple minutes of that. Pre-COVID, there was a lot of interest in companies that were netting out, having an EBITDA figure of about 2 million or higher. Private equity was getting ramped up. And to be sure, private equity has been out there for decades, but it's really gotten ramped up the last 8 to 10 years. Pre-COVID, it started getting pretty frothy. They were starting to lower their thresholds. They were looking at deals, a million in EBITDA. Then it got to 750 in EBITDA. Then it got to 500,000 in EBITDA. And I'm talking platform companies, not add-ons, where they already had a platform that they in an industry they were comfortable with, and they were just adding to it with smaller companies. They were putting new money into new opportunities that they hadn't been exploring yet as a portco at lower and lower EBITDA thresholds. Then came COVID. We all know what happened there. Deal flow locked up all of 2020, most of 2021. 2022 was lights out, but it occurred to me that buyers were sharpening their pencils. They were getting a lot more risk averse. They were wanting to make sure that if they're going to put this capital, and by the way, their EBITDA threshold was right back up to 2 million plus once deal flow started going again after the pandemic, first year and a half or so of the pandemic. They were wanting to make sure that if they're going to put that capital to work, that it was going to be well spent. They were doing a lot of deals because remember, there was a lot of pent up deal flow, deals that might have gotten done in 2020, 2021. If the owner was still alive and wanted to sell and, the buyer pool was still interested, deals were getting done at an incredible pace in 2022 and much of 23. It occurred to me then that at that time, this was about 22, 23, where the prices of well-run companies, optimized, as I say, again, had that team of advisors around them most likely. The owner knew what value was. The owner knew how to start thinking like a buyer. They were wanting to get ahead of problems long before due diligence got started. The prices of those well-run companies were being bid up. Those multiples were rising at a good clip. Contrast that to the other end of the barbell, if you want to use a barbell analogy, where companies were smaller. I noticed that those companies were going to be bought by guys like you and me, individuals that might have to go to SBA or one or two investors be brought in. They were not willing to pay as much. They were not willing to pay these rising multiples for businesses. And so the multiples of smaller companies got, I won't say hammered or pummeled, but we definitely started to see less interest in smaller opportunities. It was at that time that I made the personal decision to move up market, start dealing with companies at the $1.5 million, $2 million of EBITDA floor and above. And I love dealing with sophisticated buyers like PE and family offices and strategics. That dynamic persists today, Kevin. It has not changed that I've been able to notice. That dynamic where smaller companies are staying small, their multiples are staying, around 3 to 4 maybe, where they not far above where they were pre-COVID. But the multiples on companies that are well run, there's still a lot of competition for those. So I would encourage owners listening or advisors helping them, get your companies optimized, know what you're going to be in for, get your owner thinking like a buyer, build that team around them, and build a company that multiple buyers are going to be wanting to compete for.
I think it's fascinating to see too, as you live that and work with so many owners throughout that journey. It's still, again, we talked about waves earlier, just a ripple effect. Years on now, we're the halfway through the decade, which is crazy to think about at times. But like you said, you're seeing the downstream effect of it in real time. And I think the great thing is that there's opportunity there through leveraging our platform, through having those conversations, like you said, to the advisors out there listening, anyone who's in and around has interest in getting into the space where there's still plenty of opportunity abound, and really making sure that everyone has those tools to leverage it and has the accessibility is going to continue to be our mission and to continue to deliver the best possible offering and insight to everyone to be that ready company to make sure that they're prepared for that moment and not caught by the wayside.
Excellent. Proud to be on the journey with you guys, and looking forward to future innovations.
A lot of great things to come, Bob, and we appreciate you being there throughout the entire process to where we're at today and what's to come in the future. We know you're going to be a big part of that, and there's going to be a lot of great success stories and business owners, thanks to our partnership, who are going to be able to reap the rewards of a tremendous exit and those other effects and positive emotions that will come from it. So to wrap up here, Bob, I know we could go for quite a bit still, just given how great this conversation has been and all of our conversations through the years. But if you just want to maybe close with anything else that's top of mind and also where everyone can find you and exit teams.
I would say while the owner still has time, money, great people, and their own health, and that factor has become pretty important here lately, their own health. Time, money, the great people they already employ, and their own health. Get that company ready, get it optimized, get it ready for prime time. It's going to make a world of difference. As far as where you can reach me, I'll give you my personal cell phone, 770-633-1083. Email address, pretty simple, bob@exitteams.com.
Appreciate you taking the time again to share so much great insight and knowledge with our entire community here. And we're grateful again for our partnership and you being such a crucial part of our community through the past decade plus.
Awesome. Thanks.
Thanks, Bob. We'll do it again soon. Take care.